Picture this. It's a gloomy Sunday afternoon, August 18, 1991. Outside, the absolute chaotic remnants of Hurricane Bob are just violently pelting the massive glass windows of 7 World Trade Center in New York. The weather outside is entirely miserable, but honestly, it's absolutely nothing compared to the storm brewing inside. Inside, you have the sheer, staggering scale of the Salomon Brothers trading floor. Now, normally, this place is deafening. It's packed with hundreds of screaming traders, ringing phones, and salespeople shouting over each other. But today, it is eerily, terrifyingly quiet. It's completely empty. Well, almost empty. Just a couple of highly paid department heads are sitting there alone in this heavy, deafening silence. They're just staring at the clock, waiting to be called into the boardroom. They are essentially waiting for a death sentence. The atmosphere in that room is completely suffocating. It's just thick with this extreme, creeping, gut-wrenching uncertainty. We're talking about an absolute apex predator of Wall Street, a firm so unbelievably powerful, so rich, and so arrogant that everyone thought they were completely untouchable. But right now, they are on life support. They are literally just sitting there, waiting to hear if the United States government is about to pull the plug and bankrupt them overnight. No trial, no drawn-out battle, just instant death. Welcome to This Explainer. Today, we are unraveling one of the most incredible, suspenseful corporate dramas in financial history and discovering how a few silent men almost brought down the global economy. But look, before we get inside that terrifying boardroom on that stormy Sunday, we really have to back up and ask a fundamental question here. What on earth actually brings a $2 trillion market to its knees? I mean, how does a legendary investment bank, a bank that practically invented the modern bond market, find itself standing on the absolute brink of total unrecoverable annihilation? We aren't talking about some risky penny stock gambling here. We are talking about the United States Treasury market. This is the world's piggy bank, guys. This is literally how the United States government keeps the lights on, pays the military, and funds the nation. It's universally considered the deepest, most liquid, and absolutely safest market on the planet. Everyone believed it was just way too big to rig. There's no way you could manipulate it, right? Wrong. Somehow, this invisible creeping rot had set in deep within the system. And it wasn't just threatening to take down one single firm. It was threatening the integrity of the entire global financial system. But to really understand what happened, we can't just jump straight to the actual act. We have to look at the breeding ground. We have to look at the culture that made this disaster absolutely inevitable. To really wrap your head around this rot, you have to step straight into the cultural heart of 1980s Wall Street. It was a wild, unprecedented era, and it was completely defined by one simple, brutal, unspoken mantra. Making money was mostly what mattered, period. Nothing else. This was the exact era so famously chronicled in that classic book, Liar's Poker. You see, Salomon Brothers had grown at this mind-blowing pace. They literally tripled their workforce. They went from 2,000 to 6,000 people in just 5 years. That is massive expansion. But here's the catch. As they grew, they didn't build a cohesive, unified team. Not even close. Instead, as one insider perfectly put it, competing internal fiefdoms totally replaced interconnected businesses. It was this environment of intense, unapologetic, almost theatrical arrogance. It was a place where bluffing wasn't just some fun little game you played with dollar bills in the boardroom after hours. It was an absolute art form. It was how you survived. The market inside those walls valued lies way more highly than the truth. Seriously. If you were a salesman, your job was to overpraise completely mediocre investments. If you were a trader, you pretended to sell when you actually desperately wanted to buy. And if you were a junior guy who actually believed everything your superiors told you, well, you were considered a gullible fool. It was a snake pit. And, this incredible arrogance, it wasn't just a bad attitude. It was hard-coded into Salomon's actual corporate DNA. The guy running the show was Chairman John Gutfreund. At the time, he was easily the most famous, most feared figure on all of Wall Street. Under his leadership, fierce, cutthroat fiefdoms completely replaced any sense of teamwork. For example, the mortgage department pulled in the most money, right? So they operated like this isolated, untouchable island. Why? Because as the head of that department once noted, literally everyone else in the firm wanted them to fail out of pure jealousy. That is wild. Inside Salomon, loyalty was priced exactly like a bond. If the cost of keeping a promise to an employee became too high, management simply sold out. Gutfreund had this really notorious habit of firing entire departments of fiercely loyal employees the absolute second a market dipped, completely ignoring previous promises of job security. So this culture naturally cultivated a very, very casual attitude toward the truth.
Honestly, Gutfreund himself had this natural, almost scary ability to confuse his own personal self-interest with high moral principle. And when your top management routinely operates in this kind of reality distortion field where self-interest always justifies deception, that toxic attitude just bleeds straight down to the trading desks. And that right there brings us to the actual mechanism of the impending doom.
Okay, so the actual fuse for this entire massive disaster was lit by just one single simple number, 35%. Let me explain. To prevent any one giant bank from completely monopolizing America's national debt, the government had a very strict rule. Historically, the Treasury didn't really limit bids, but they did limit how much any one entity could actually purchase to 35% of the total auction. Simple enough, right? Well, in July of 1990, a Salomon managing director named Paul Mozer got incredibly furious at the Treasury over this whole setup. So, in what basically amounted to a high-stakes temper tantrum, he submitted these aggressive protest bids at successive yields just to intentionally manipulate the outcome and mess with the Treasury. He's basically flexing his muscles. Well, the Treasury Department did not find this funny. In response to his blatant arrogance, they instituted a strict brand new rule. From now on, no single entity could even bid for more than 35% of a new issue security. Period. Paul Mozer absolutely hated this rule. He felt it totally constrained his massive aggressive trading appetite. And remember that culture we just talked about? In the culture of Salomon Brothers, a rule you didn't like wasn't a hard boundary, it was just a creative obstacle waiting to be bypassed. So, faced with a government rule he completely despised, Mozer orchestrated a deeply, deeply dangerous scheme. We're talking about ghost bids. Now, the U.S. Treasury allows primary dealers, which Salomon was, to submit bids on behalf of their customers. So Mozer figures, hey, if I can't bid for more than 35% under Salomon's name, I'll just hijack the corporate identities of my biggest clients. And I'll do it without ever telling them. It is stunningly brazen. He targeted major, highly established clients, big names like the Quantum Fund and Mercury Asset Management, which was a very well-known subsidiary of S.G. Warburg. He was essentially just stealing their names to illegally corner the multi-billion-dollar government bond market. He was treating his own trusted clients as totally clueless pawns in his massive game of high-stakes financial dominance. He just assumed he was smarter than everyone else and that no one would ever catch him. The actual mechanics of this scheme were just breathtakingly brazen. Because Treasury auctions slice up the pie based on how much you bid, Mozer realized that to get a much bigger slice for himself, he just had to invent completely fake demand. So let's walk through it. Step 1. On February 21st, 1991, the Treasury auctioned $9 billion of 5-year notes. Mozer submits a $3.15 billion bid for Salomon. That's the max, 35%. Perfectly legal so far. But then, he submits 2 additional $3.15 billion bids using the stolen names of the Quantum Fund and Mercury Asset Management. Step 2. The auction results come out, the pie is sliced up, and Salomon receives a massive influx of securities. By using those fake bids, Salomon effectively walked away with 56.7% of the entire auction, way over the legal limit. Now, step 3 is where the real cover-up happens. Mozer casually directs a clerk to write up fictitious trade tickets. These tickets supposedly show Salomon selling the illegally won securities to the customer accounts, but then immediately writing reverse tickets selling them right back to Salomon. It was an illusion. Finally, step 4, and this is the kicker. To keep the actual clients completely in the dark, Mozer explicitly overwrites strict internal control procedures. He literally commands the clerk to suppress the trade confirmations. The clients never got a piece of paper, they never saw a single thing. It really was a perfect, completely invisible crime.
But here's the thing about perfect crimes, right? Perfection is always an illusion. The fatal twist of fate in this story didn't arrive from some brilliant audit or a whistleblower. It came from sheer, absurd, terrible luck. An absolute coincidence. On that day, February 21, Mozer commits this massive fraud using the Mercury Asset Management name. But in that exact same auction, S.G. Warburg, which remember is the parent company of Mercury, legitimately submitted their own $100 million bid. And by pure chance, they submitted it at the exact same 7.51% yield that Mozer had used for his fake Mercury bid. So the Treasury is looking at the books, and they notice that these 2 affiliated companies just bid for more than 35% combined. It flags in their system. So in mid-April, the Treasury sends this very polite, totally routine regulatory letter to Mercury Asset Management over in London, basically just asking, hey, what's up with this bid overlap? And they copy Mozer on the letter. Mozer absolutely panics. His blood runs cold. He immediately calls the client, lies through his teeth, says it was just a silly clerical error, and practically begs them to just keep it quiet and let him handle it. but he knows the walls are closing in fast. The secret is out. So on April 24th, Mozer walks into the office of his immediate supervisor, Vice Chairman John Meriwether. He hands him the Treasury letter and confesses to the whole massive fake bid. Meriwether is completely shocked. He looks at Mozer, tells him his actions are incredibly career-threatening, and asks him point blank if this was just a one-time aberration. Mozer, of course, being who he is, lies again and promises it was just a one-time thing.
Now, what happened next is, without a doubt, one of the most catastrophic failures of leadership in modern corporate history. Listen to this. Meriwether immediately goes and tells President Thomas Strauss. Strauss then brings in the chief legal officer, Donald Feuerstein. And finally, the three of them brief the big boss, Chairman John Gutfreund. The legal officer, Feuerstein, explicitly and clearly tells all of them that submitting a false bid to the United States government is a federal criminal act. He strongly advises them that they are legally obligated to report it to the Federal Reserve Bank of New York immediately. So think about this. You have the foremost powerful men at the absolute top of this massive firm staring straight at a confessed, highly illegal act that threatens the very bedrock of their entire business. And what did they do? Take a guess. Absolutely nothing. For months, an epidemic of agonizing, completely arrogant paralysis just took over the executive suite. They didn't fire Mozer, they didn't suspend him, they didn't even launch an internal investigation to see if he was lying about it being a one-time thing. They literally did nothing. Each of these powerful men just basically assumed someone else in the room was going to handle the messy part. Gutfreund would actually later claim he thought it was just a minor aberration and not a high priority. Let that sink in. Submitting a multi-billion-dollar fake bid to the U.S. government was deemed not a high priority. And because he faced absolutely zero consequences, Paul Mozer did exactly what you'd expect. He didn't stop, he escalated. To a guy like Mozer, management's complete silence was interpreted as a giant, flashing green light. It was tacit approval. So just one single day after confessing to upper management, one day, on April 25th, Mozer submitted another massive fake bid. This time in the name of Tudor Investment Corporation, padding their legitimate order with $1 billion of totally fake demand. Then, on May 22nd, he struck yet again. He submitted a $2 billion bid for Tiger Management when they had only actually authorized $1.5 billion. He casually siphoned that extra $500 million right into a proprietary Salomon account. And to make matters even worse, the guy also started secretly hoarding hundreds of millions in securities from the Treasury on that exact same day, to corner the market and squeeze the short sellers. It was absolute madness. By doing absolutely nothing, the executives at Salomon turned what was a severe internal crisis into a completely unmitigated catastrophe. But eventually, the bill always comes due. The House of Cards finally collapsed in the summer of 1991. In late June, regulators naturally start poking around the incredibly suspicious May 2-year note auction. Because things looked weird, in July, Salomon officially retains an outside law firm to look into it. Now, when these outside lawyers started asking just basic routine questions about customer authorizations to the trading desk, a desk trader flat out refused to answer them without speaking to the internal in-house counsel first. That hesitation sparked an immediate chain reaction of massive internal panic. That giant red flag forces the chief legal officer to finally break his silence and tell the outside lawyers about Mozer's confession way back in February. Suddenly, the investigation blows wide open. The horrific, undeniable truth is fully uncovered. Mozer had submitted false bids in December, February, April, and May, totaling over $15 billion in fraudulent, illegal activity. It's a staggering number. So, on August 9, Salomon has no choice but to issue a press release vaguely admitting to some irregularities. But the real bomb drops a few days later when they are forced to admit that top management actually knew about the crimes since April and said nothing. The market recoils in absolute sheer terror. Furious clients instantly flee. The company's stock completely plunges. It is a bloodbath. Which brings us right back to the beginning of our story. That stormy Sunday, August 18, and that terrifying, silent boardroom. The United States government is, to put it mildly, absolutely furious. They have been lied to, manipulated, and made to look like fools. The Federal Reserve and the Treasury Department held three massive existential threats right over Salomon's head. First, they could institute federal criminal charges against the firm, which would destroy their reputation permanently and land people in prison. Second, they could outright ban Salomon from ever participating in Treasury auctions altogether. Third, and by far the most deadly, They were considering revoking their primary dealer status. Now, if Salomon couldn't trade directly with the Fed as a primary dealer, their massive daily funding would evaporate instantly. Poof, gone. They simply wouldn't be able to fund their absolutely massive balance sheet. As the firm's treasurer realized with sheer horror that day, losing that status wouldn't just hurt the firm, it would be instantly, unequivocally fatal. They would be bankrupt by Monday morning when the markets opened. Game over, lights out.
So you're literally hours away from total bankruptcy. How on earth do you survive? Well, they desperately needed a savior, but not just anyone. They needed someone with absolutely unimpeachable credibility and integrity. Enter Warren Buffett. Berkshire Hathaway was actually Salomon's largest single stakeholder at the time, with a massive $700 million investment on the line. He could not afford to watch this company just vanish into thin air. So in that frantic, highly emotional August 18 board meeting, the architects of the silence, Gutfreund, Strauss, and Meriwether, are forced to resign in absolute total disgrace. They are out. Buffett officially steps in as the interim chairman of Salomon Brothers. But here's the crucial part. Buffett isn't just stepping in to blindly defend the bank or protect the old boys club. He gets on the phone and explicitly tells the government that he will personally order a massive, fully independent investigation. And he makes a promise. If he finds that this rot goes any deeper than Mozer and those silent executives, he will personally walk away and let the firm die. He won't protect them. His absolute unwavering commitment to a just outcome earns Salomon a razor-thin, miraculous stay of execution from Treasury Secretary Nicholas Brady. They survived the weekend. But the hard work was just starting. The very first thing Buffett did on Monday morning was completely and utterly obliterate the toxic money-at-all-costs culture that John Gutfreund had built. He stood up in front of the firm and delivered what is now a legendary, absolutely ruthless ultimatum to the remaining employees. He said, "Lose money for the firm and I will be understanding. Lose a shred of reputation for the firm and I will be ruthless." Now, you have to understand, this wasn't just some clever PR soundbite for the media. It was a brutal, cultural 180-degree turn. Buffett mandated radical transparency across the entire organization. He explicitly told his employees to measure every single act not just by what is technically legal, but by what they would be happy to see printed on the front page of a national newspaper, written by an unfriendly, highly critical reporter. If it couldn't pass that test, you don't do it. He shifted the firm's fundamental DNA overnight. It went from a place of arrogant deception and rule-bending to a place of absolute, unquestionable integrity.
This strategy of radical transparency and cooperation actually worked. It saved the firm from complete destruction. But let me tell you, survival came with a truly staggering price tag: $290 million. In 1992, the Department of Justice and the SEC finally announced this massive civil settlement. At the time, guys, this was the largest fine ever levied on an investment bank in history. It was a massive wake-up call. This total included $190 million in heavy fines and asset forfeitures paid directly to the U.S. Treasury, plus the establishment of a $100 million restitution fund, set up specifically to compensate the victims of the market manipulation. And it wasn't just the company's wallet that took a hit. The top executives paid heavily for their silence. Gutfreund, Strauss, and Meriwether were hit with massive personal civil penalties and very severe industry suspensions. In fact, John Gutfreund, once the king of Wall Street, was permanently banned from ever being a CEO of a brokerage firm ever again. His legacy was in ashes.
The legacy of this entire scandal completely altered Wall Street forever because of Warren Buffett's unprecedented, exceptional cooperation. I mean, literally turning over massive boxes of internal documents, fully waiving corporate privileges, and radically, completely restructuring the management team. The Justice Department took a highly extraordinary step. They decided to drop all criminal charges against the firm itself. They finally realized that completely destroying Salomon Brothers would actually hurt the fragile global markets way too much. But you better believe regulators learned a massive, terrifying lesson from this whole ordeal. They realized that the regulatory system overseeing the world's most important market had massive, gaping cracks in it. So this near catastrophe directly catalyzed the creation of the TMPG, the Treasury Market Practices Group. Think of it essentially as a high-level, extremely powerful neighborhood watch for the Treasury market, where fierce competitors now actively work together to safeguard market integrity and establish strict best practices. All of this to prevent this exact type of catastrophic failure from ever happening again.
As we wrap up this explainer, I really want to leave you with a thought to chew on. Just how fragile is trust in a multi-trillion-dollar market? It is honestly terrifying to realize that a market so incredibly vital to the daily funding of the United States and the absolute stability of global finance was nearly toppled. And it wasn't toppled by some massive foreign attack or a global pandemic. It was almost brought down by the out-of-control arrogance of a single rogue trader and the silent, paralyzing cowardice of a few wealthy executives who honestly just thought the rules didn't apply to them. It literally took the ruthless, unwavering integrity of an complete outsider to step in and clean up the mess. It proves that in the world of high finance, your reputation isn't just some cute marketing buzzword to throw on a brochure. It is the actual, literal currency of your survival. I want you to think about that the very next time you hear a politician or a banker talk about a too-big-to-fail institution. Because as we've seen, nothing is too big to fail if the rot goes deep enough. Thank you so much for diving into this incredible story with me.